Good morning, everyone, and thank you for joining us on Morning Markets as we look to the week ahead. So today, just looking back a little bit at what happened in asset markets last week, we continue to discuss the good performance that we were seeing from equity markets. Indeed, if we look at broad-based measures, probably 2 weeks in a row that we've seen equity markets start to show some recovery and a positive trend post the challenges at the beginning of the month. The other side of that is just what we've seen in bond markets, in one of the areas that maybe isn't front and centre of the newspapers or in the media, but really important to the functioning of the financial system. And clearly there we've seen a slightly different performance with bond yields continuing to rise across a number of geographies. And just this morning, looking at some charts on the screen, it's really quite instructive. If we look at where we've got to in terms of the US and the UK 10-year bonds, they're now back to levels that we last saw in May 2019. And you'll have heard us talking about the German Bund and its negative yielding characteristics. It was negative on the 4th of March, indeed flirting with that 0% level. Only today, looking at where we are, 0.59%. So quite a movement that we've seen in bond prices and as a result yields over the past month. I think the other things then, looking to just the week ahead, quite an important week for data from the US. And I say that because it's measures that will help get a sense of how the two important factors are evolving: inflation and then by inference monetary policy, and also the employment backdrop. So firstly, with inflation, we get the personal consumption expenditure index, which is the Fed's main measure that they look at, and indeed, like all inflation measures in developed markets at this point in time, has continued to creep up. Our last reading there was 6.1, an expectation that it will increase. It's important because the Fed focuses on that. They have a target around that, an average level of around 2%. So that gives you some indication as to why we're seeing the aggressive monetary policy manoeuvres that we are seeing. Indeed, when we look at what's been priced, 0.5% increase expected at the next Federal Reserve meeting on the 4th of May. As a result, some 80% implied probability of that. The other thing is we get at the start of every month, the first Friday of the month, is the US employment report. We've discussed the strength of employment over recent months, and again, that's feeding into the inflation and interest rate narrative. Why is that? Because we're seeing employment at 3.8, unemployment I should say, at 3.8% in the US, and the participation rate also starting to improve. So near full employment as the Fed would describe it. So really they have to move on interest rates and the quantitative tightening, and that's what the market is pricing. I think the other thing just to think about over the week is ongoing news flow from China. Very different approach there to COVID, zero COVID effectively, and we've seen that in a number of areas over recent weeks in terms of smaller lockdown measures. But today we've seen the announcement come through that Shanghai, 24 million people, is going to enter a more aggressive form of lockdown for the next 9 to 10 days. So certainly a different approach. It has implications for consumption and also growth levels within China. I'll leave it there for today, but please join us for the rest of the week on Morning Markets. Many thanks.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.